Differentiating advice. Investing in mutual funds is often oversimplified. Most people think it's very simple. We are told that just doing an SIP for a very long duration of time is sufficient to become rich. But reality has a very different story to tell. I have seen the performance of the most popular SIP choices of 2000 and 2008, 2 years when SIPs were very popular. Even 10 years later, these SIPs did not deliver any returns. But at the time people chose to make SIPs in them, they were the toast, the flavor of the markets. In 2000, it was tech funds. In 2008, it was infra funds. Luckily, 2-3 years later, people tended to drop out of these funds because they saw red. But the time lost could never be regained. Importantly, people who quit SIPs after making losses never returned to them for many years. Essentially, they lost out on the opportunity to invest in bear markets. Today, there are far more number of schemes. We have hundreds of schemes. And making a choice is still based on the same principle which failed investors in 2000 and 2008. It's based on past performance. Look at how people chose SIPs in 2018. Let us now think of the most popular ones. Microcaps were extremely popular. The next most popular category was small caps, and mid caps too were very popular. Friends, making an SIP in the wrong fund can be once again leading to an exodus of investors from the markets. It is not meant to be simple, which is why the right advice counts. An investor must know to differentiate between advice which will work in the future and advice which is entirely relying on the past. The future in the stock market is meant to be very different from the past. So, advice which is given to you must differentiate the past from the future. Now, this is something which you can't really judge very easily, because if I advise you in a fund which I think will perform very well over the next 3 to 4 years, and you go online to check whether that fund is rated very high with 5-star or whether its past performance is extremely good, you will probably come up with a very different conclusion. And instead, if you go by these 5-star ratings and past performance, you may actually choose the wrong funds. Now, we are in a transformatory market where the future leadership of the stock market is set to change. A new set of companies are probably going to gain far more in valuation than the companies which did extremely well in the last 3 or 4 years. So, advice today which we receive must do quite a bit. It must capture future winners. More importantly, it must correct mistakes from the past 2 or 3 years in investment choices. If you stay in the same funds for a longer duration hoping that they will come back, you are probably going to lose more money or lose more time. Neither of these is advised. So, futuristic advice should choose future winners. It must create confidence. So, even if the fund is not showing past performance, you should be able to have the faith in the advisor, his knowledge, his ability to pick future winners, and his ability to convince you. And good advice must also manage risk till you make the returns, which means that it's not just about telling you what to buy, but ensuring you stay convinced for 3 to 4 years, during which a lot can happen and create superior returns. So, making good advice count for you is what differentiates a good advisor. The manner in which he approaches your need, chooses what is good for you, determines how you should invest your money into the investment, is clear how the risk will be managed during the period of holding, and is always diligent and cautious to protect your interest as an advisor. These are things which differentiate good advice. Differentiated advice will make good advice count for you, and the only way you can do it is by counting on a good advisor. Happy investing. Thank you.